Happy Friday, IHMC friends and family. It's Shayan from Integrity Home Mortgage, back with your weekly mortgage market commentary. June was off to a much better start for mortgages than May, but we've given back all the midweek gains and then some at this point. 10-year Treasury yields are up about 8 basis points, and mortgage prices are down about 15 basis points from where we opened the month just on Monday. There's a tug of war going on between signs of continued slowing economic growth and the ever-present fear of resurgent inflation. As I've said before many times, we're in that bad news equals good news cycle for everything except inflation. So the bad news about slowing growth wants to push interest rates lower, but the fear about future bad news around inflation is pressuring them back up. So let's take a second to talk about the three things fueling that battle this week: jobs, trade, and the Fed, right? So it's jobs. There was a lot of data released this week on jobs, and the picture it painted was of a weakening labor market, but really everyone was just kind of waiting around for this morning's non-farm payroll number. On the positive side, job openings were up, so it means on some level hiring is still happening within the economy, but ADP's number was a big miss this week, showing only 37,000 new jobs were added last month, which is the lowest level since February 2021. That was the second consecutive week report, and the data showed that small businesses are really feeling the brunt of the pain, accounting for most of those layoffs. Challenger job cuts showed layoffs over the first 5 months of 2025 are up 80% versus that same time in 2024, which is the leading cause, and the leading cause of that being DOGE impacts. So naturally, that means a significant number of government jobs, but it shows that there are also ripples being felt through the tech sector, defense contractors, healthcare, etc. Also, jobless claims hit an eight-month high. Now, this morning, sentiment took a hard about face when the non-farm payroll number came in higher than expectations at 139,000 new jobs last month, and the unemployment rate remained unchanged at 4.2%. Bond markets are reacting as if this is a strong report, meaning that mortgage rates are pushing higher today. But there is some notable underlying weakness in the data. So it could be that things return back to normal after markets have been given a day to digest. Last month's number was revised lower by 30,000 jobs. The participation rate fell, meaning more people are giving up on finding a job at all. And average earnings went up, meaning that the amount it costs to employ people went up. So let's move on to trade. Trade these days equals inflation. So it's very, very important, right? President Trump and President Xi had a call on either yesterday or Wednesday. After several weeks of stalled trade talks, no breakthroughs were reported, but the fact that communication is happening at that level shows progress. Remember, there's no trade deal in place between the U.S. and China. It's only a 90-day truce before tariffs go back up to 145% and trade comes to a screeching halt again. Trade talks with the EU have also stalled, and we only have about 30 days left on that clock. So that's the reason why inflation fears are continue to be ever present. Moving on to the Fed, or really just kind of central banks in general, the ECB, the European Central Bank, lowered rates this week for the 8th consecutive time. They highlighted the fact that inflation is at their 2% target, and they made note of citing trade tensions being caused by shifting U.S. Tariff policies as a headwind to global economic activity, and that's what kind of motivated them to cut rates this week. We're less than 2 weeks away from the next Fed meeting, and the odds of a rate cut domestically here are at 0%. We're going to get some important inflation data in the form of CPI on Wednesday and PPI on Thursday. The constant head fakes on trade policy implementation means that these numbers should be seen as real, meaning that there's not going to be tariff, inflation in these numbers. It's just regular old inflation. These numbers are going to come in early enough for the Fed to consider, but as a result of the fact that the media blackout starts tomorrow, we will get no comments on it from the Fed. And the market is still pricing in about 2 cuts for the rest of 2025 and for those cuts to begin in September. But remember, that is not a reason to wait in any way, shape, or form, right? If 2 cuts are being priced in and 2 cuts are what we get, there should be no impact to rates at all. If 2 cuts are priced in and we only get 1, even despite the fact that the Fed is cutting rates, you will see rates go back up. So lock them early, lock them often. I hope you have a great weekend, and we will see you next week.